Okay, you guys, we're now going to work problem 5-2A, some sales transactions for a merchandising business. That problem is on pages 256 and 257. Again, the chart of accounts we're using, the accounts you can pick from, are on page 227. And we've already looked at purchase transactions. On all the purchase transactions, of course, you guys, we were the buyer. On all of these transactions, we'll be the seller. And I'm going to put that in as my name here. Okay, we're going to be the seller on all of these, and we're using a perpetual inventory system still. Okay. All right, now your grade will update here as we go, and it'll be the same on your homework template. Now, one thing about making sales, you guys, we talked about there's sales tax to a retail customer, no sales tax, wholesale or business to business. Also, let's see, what else? If there's a credit card sale, we're going to treat that like cash. But a couple of things that we haven't mentioned. Anytime you make a sale of inventory, it's going to require two journal entries. One at the sales price to record the revenue and the asset and the associated asset. Then one at the cost of the inventory to record the expense associated with the sale and the reduction in the inventory account. You'll see how that goes as we move along. But let's start with March 2nd, again on page 256. It says sold merchandise on account to Equinox Company 18.9. Terms FOB destination, meaning the seller is responsible for shipping charges, and on this problem we're the seller the entire time. We offered our customer a 1% discount to pay within 10 days. Otherwise, the full amount's due in 30 days. And the cost of the merchandise sold was $13,300. Okay, you guys, that $18,900, that's the sales price. And the $13,300 is the cost of what we sold. Okay, first at the sales price, we're going to debit. How did we make the sale, you guys, for cash or on account? Well, if they're telling us we get a discount in 10 days and we have to pay in 30 days, that means we made the purchase on account. So we're going to debit accounts receivable Equinox Company for $18,900. And we also want to record the revenue. Remember, our new revenue account is called sales. Revenues increase on the credit side. So we're going to credit sales to increase its balance, $18,900. Okay. Now, we don't do anything with the FOB destination. Destination does mean that we, the seller, are responsible for shipping charges. But you guys, we don't have our own freight of delivery trucks. Instead, if you'll skip ahead and look down to the last transaction on March 31st, it says paid Fleetwood delivery service $5,600 for merchandise delivered during March to customers under shipping terms FOB destination. So we're just contracting out those deliveries to a third-party carrier. They're billing us at the end of the month, and we're paying them then. Okay, so we don't have to worry about transportation charges as we're going through this problem. Not destination contracts anyway. We'll pay for that once at the end of the problem, or near the end of the problem. Okay, our second entry required on March 2nd deals with the reduction in inventory. We want to increase our new expense account, cost of merchandise sold, by the cost of the inventory that was sold, $13,300. Remember, expenses increase on the debit side. Then we're going to credit the asset account, merchandise inventory. We now have less inventory than before. So we'll credit merchandise inventory for $13,300. We'll have to make two entries every time we make a sale, you guys. The first entry records the sale itself. That's this entry. The second entry records the increase in cost of merchandise sold and the decrease in inventory. Okay, on the third, sold merchandise for $11,350 plus 6% sales tax to retail cash customers. Cost of merchandise sold was $7,000. Okay, we're selling to a retail customer, so there is going to be sales tax. They're paying us in cash, so our asset account cash is going to increase. They increase on the debit side, but how much cash are we going to receive? Well, it's going to be equal to the sales price, $11,350, times, well, you guys, we could multiply by 6% to get the amount of the sales tax, or we could multiply times 1.06 to get the full amount of cash received. Multiplying by 1 gets us back to the $11,350, and multiplying by the 0.06 includes the sales tax. So if you take the purchase price, $11,350, and multiply times 1.06, that gives us the amount of cash received, $12,031. Okay, now we want to record the revenue, so we'll credit sales to increase the balance of our new revenue account. Well, we'll record the sale at the actual sales price, $11,350. Now the sales tax, we're going to credit to a liability account. You guys, it's a liability for us because as soon as we collect it from the retail customer, we owe it very soon into the state, usually before the 15th of the following month. So it creates a liability for us called sales tax payable. And then that liability would be equal to $11,350 times 0.06, just the sales tax percentage here. That gets you to $681. And notice that balance is our entry. If you add together your two credits, you get the amount of the debit to cash. Okay, so we debited cash to increase the balance of the asset account. And we debited it for the sales price, $11,350 times 1.06, so that the cash received includes the sales tax. We credited sales, the revenue account, to increase its balance for the sales price. And we credited the liability account, sales tax payable, to increase its balance by the amount of sales tax on the sale, which was our $11,350 times 0.06. Okay, our second entry on the third, we're going to debit the expense account, cost of merchandise sold, to increase its balance by the cost of what was sold. That was $7,000. And we're going to credit merchandise inventory. The asset account decreased because we sold inventory, right? We now have less inventory. Okay, remember, 2 journal entries each time you make a sale. One at the sales price, one at cost. Okay, on the fourth, sold merchandise on account to Empire Company, $55,400. Terms FOB shipping point, which means the buyer pays shipping charges, so we're not concerned with those. We did not offer Empire Company a discount. We just said the full amount's due at the end of the month. And you guys, maybe, there's all types of reasons why we might not have offered them a discount. Anyway, we don't really have any information to go on as to why we didn't. They just said the full amount's due. We just told them the full amount's due by the end of the month, and cost of merchandise sold was $33,200. Okay, first to record the sale itself, we made the sale on account. So the asset account, accounts receivable, Empire Company, increases by $55,400. And then we're going to credit sales, our revenue account, to increase its balance by $55,400. We don't deduct the discount yet because we don't know if Empire Company is going to pay within 10 days. Sorry, we're not even offering them a discount. We didn't include the discount back on the 2nd for Equinox Company because we don't know, just like with the purchase transactions, if our customer is going to take the discount yet or not. Okay, we'll figure those out a little later. All right, now we have to make a second entry on the 4th. We're going to increase our expense account, cost of merchandise sold, by $33,200. And we're going to credit our asset account, merchandise inventory, to decrease its balance by the cost of what was sold, $33,200. Okay, we'll start back with the 5th in the next video. Thanks.